Gold just dropped 8,000 rupees in India, while at the same time blasting past $4,250 globally. What on earth is happening? This is not normal. Here's the story. Gold went absolutely bonkers. One minute you think you know what's happening. The next minute the market flips the script on you. That's exactly what we saw on Friday, November 14th, 2025. It was a tale of two completely different worlds. In India, the headlines were screaming about a massive price crash. Buyers woke up thinking they hit the jackpot. But if you looked at the global screen, the ticker was glowing green. Gold was pushing higher, looking strong. This wasn't some small blip, folks. This was a major divergence, a real head-scratcher that left people from Delhi to New York asking, what in the world is going on? This is chaos, pure and simple. You had headlines flashing, gold plummets by rupees 8,000, right next to tickers showing the metal climbing past $4,150 an ounce. It's like watching two different games being played on the same field. Confusing, you bet, but that's the market for you. It's never simple, and it's never quiet. My job today is to cut through that noise. We're going to break down this madness piece by piece. We'll look at the shocking drop in India. We'll look at the surprising strength on the world stage. Most importantly, we're going to figure out what this chaos means for you, whether you're buying a bracelet or trading a billion-dollar fund. This isn't just an academic exercise. These wild swings have real-world consequences. For an Indian family saving for a wedding, a sudden price drop is a massive opportunity. For an American investor using gold to hedge against uncertainty, the global surge is a sign their strategy is working. The disconnect between these two realities is where the real story is. It's a story about government shutdowns, central bank whispers, currency fluctuations, and good old-fashioned human psychology. It's a messy, complicated puzzle, but we're going to put the pieces together. So, buckle up. We're going on a deep dive into the gold chaos of November 2025. Booyah! Let's get right to it. The numbers in India were staggering. On Friday morning, the local market got hit with a sledgehammer. We're talking about a serious haircut for gold prices. 24-karat gold, the pure stuff. It tumbled to around rupees 12,800 per gram. That's a drop of rupees 77 in a single day. That might not sound like much, but scale it up. It's a monster move. Buyers eyeing a 100-gram bar saw the price tag slashed by nearly rupees 8,000 overnight. That is not chump change. A significant eye-popping discount that gets attention. It wasn't just 24-karat that took a beating. The pain was felt across the board. 22-karat fell to about rupees 11,735 per gram. 18-karat dropped to rupees 9,604 per gram. This came right after a strong jump in prices just a day earlier. Imagine you hesitated on Thursday. You wake up Friday and feel like a genius. If you bought on Thursday, you're feeling the sting. This volatility is a classic sign of an uncertain market, one where buyers and sellers are in a fierce battle. So why the sudden collapse in India? What happened? It's a mix of local flavor and market mechanics. First, profit-taking. Gold had been on an absolute tear, up nearly 60% year on year. They hit an all-time high just a few weeks ago in October. When a commodity runs that hot for that long, traders get itchy. They see a chance to lock in massive gains, so they sell. When many big players sell at once, it creates a tidal wave of supply. It's a classic case of sell the news. On top of that, the demand factor. India is the world's biggest consumer of gold, but even Indian buyers have limits. After a parabolic rise, sticker shock sets in. This cooling of physical demand removes a key pillar of support. So, professional traders selling from the top, and everyday buyers stepping back from the bottom. That's a recipe for a sharp, localized correction, like the one we saw. While India was dealing with its price plunge, the global market was singing a completely different tune. On the international stage, gold was flexing its muscles. The price, measured in US dollars, was climbing. It pushed above $4,150 an ounce and was holding strong around the $4,080 to $4,100 level. Just days before, it had flirted with a multi-year high of over $4,240. This wasn't a market in retreat. This was a market showing resilience, consolidating gains and hunting for the next reason to launch higher. So what was fueling this global fire? A gigantic cloud of uncertainty hanging over the United States. America had just stumbled out of a record-breaking 43-day government shutdown. For over a month, crucial economic data was not being released. The market was flying blind. Investors hate flying blind. When fear and uncertainty rise, where do they run? They run to the ultimate safe haven, gold. The end of the shutdown was the trigger. Investors unwound emergency positions, but the fear didn't just evaporate. The market braced for the flood of delayed data, especially the jobs report, with expectations the numbers would be ugly. A long shutdown with nearly 1 million furloughed and millions unpaid was bound to hurt the labor market. A weak labor market could signal a slowing US economy, which is another powerful reason to seek the safety of gold. Furthermore, a weaker US economy often leads to a weaker US dollar, and gold and the dollar generally move in opposite directions. When the dollar goes down, gold goes up. Gold is priced in dollars globally. When the dollar weakens, it becomes cheaper for investors in other currencies to buy gold, boosting demand and price. Safe haven demand plus a softer dollar created a powerful tailwind for global gold. Just when you think the story is simple, fear pushes gold up. The Federal Reserve steps in to complicate things. The Fed is the big boss. Several officials delivered hawkish commentary, signaling they weren't in a hurry to cut interest rates, keeping policy tight to defeat inflation. Gold pays no dividend or interest. Government bonds do. Higher rates lift bond yields, making bonds more attractive than zero-yield gold. It's a constant tug of war. The fear trade says, buy gold. The interest rate trade says, sell gold and buy bonds. That's why price action turned choppy. Markets don't move in a straight line forever. As gold approached around 4,200, and especially 4,240, it hit a psychological and technical ceiling. Think of it like a ceiling. Price rallies up, hits that ceiling, and bounces down. Traders use that zone to cash in. Failure to break triggers selling. Buyers from 3,800 to 4,000 see stalls near 4,240 and take money off the table. A wave of profit-taking. We saw roughly a $120 drop from the peak. RSI and momentum cooled. Silver and platinum struggled. The rally looked vulnerable. Watch 4,000 per ounce, the new critical floor. Hold above it. Healthy pause. Break it. Look out below. The market is now in a range. The 4,000 floor and the 4,240 ceiling. The next big move depends on which one breaks first. Here's a crucial piece of the puzzle that many people miss. The price you see on a global news channel is not the same price you pay at a jewelry store in India. Why? Because the global price is in US dollars. The local price is in Indian rupees. The bridge between those two prices is the USD-INR exchange rate. This currency conversion acts like a filter. Gold is an imported commodity for India, and dealers pay in dollars. So the rupee's strength or weakness can amplify or dampen global moves. If the rupee gets stronger, it takes fewer rupees to buy a dollar, cushioning local prices. If the rupee weakens, it takes more rupees per dollar. Imported gold becomes more expensive, and local prices can skyrocket. On that chaotic Friday, rupee moves plus local profit-taking and softer demand overpowered modest gains in the global dollar price. Be a two-minded analyst, one eye on US data and the Fed, the other on India's trade balance, foreign inflows and local demand. So, where does that leave us? We are standing at a classic market crossroads. Signals are mixed. The path forward is anything but clear. On one hand, the story that drove gold up over 50% this year is still intact. Fear is still in the air. The long-term impact of the US government shutdown is unknown. Global economic uncertainty persists. Investors are desperately seeking a safe place to park cash. Every dip triggers buying. This is the bedrock that prevents a collapse. On the other hand, the market looks exhausted. The sharp, localized drop in India shows buyers have limits. Failure to break 4,200 shows the rally is tired. Hawkish Fed commentary is a headwind. High rates make bonds a serious competitor. This is what sparks corrections. That pressure could push price to test 4,000 support. For average buyers and investors, this is treacherous. Volatility is back, big time. The easy one-way ride up is over. You must be smarter and more nimble. If you're a long-term believer, pullbacks are a buying opportunity. If you're a short-term trader, volatility is opportunity and risk. A wrong step either way could be costly. Know your strategy and stick to it. Don't be swayed by daily noise. We end where we began. A massive question mark over gold. Battle lines. Bulls point to fear and uncertainty. Bears point to high rates and technical exhaustion. The Indian market marches to its own drum, influenced by local demand and the rupee. Complex, chaotic, fascinating. Now I turn it to you. What comes next? Pullback equals healthy pause before 5,000, or start of a deeper correction below 4,000? Tell me in the comments. I read every single one. If you found this update useful, hit that like button, and I'll keep making more real-time gold market breakdowns for you.